Have you ever wondered if the markets have a secret calendar? A hidden rhythm that repeats year after year? Well, today we're going to pull back the curtain on that very idea.
Welcome to AI Explains ICT. In this video, we're diving deep into the core content from Month 5, Episode 10, all about unlocking a powerful concept called seasonal tendencies.
So let's just start with a big question, right? Are financial markets really just random noise? I mean, that's what a lot of people think. But what if I told you that buried inside decades of data, there are predictable patterns, a kind of pulse that beats at certain times of the year?
Here's how we're going to break it down. First, we'll talk about what this secret rhythm actually is. Then, we'll use the Canadian dollar as a perfect case study. That's going to lead us to a super important twist for you Forex traders. After that, we'll see it all play out on the charts, add another layer of analysis, and then wrap it all up into a real, tangible edge you can use.
Okay, so this secret rhythm I keep talking about, what is it? Well, the tool we use to see it is called a seasonal tendency.
So what in the world is a seasonal tendency? Well, ICT calls it a proverbial roadmap, and that's exactly what it is. Imagine taking 20, 30, even 40 years of price data for a market and averaging it all out to see how it tends to move during January, February, March, and so on. It's a guide to the market's personality throughout the year.
Now hold on. Before we get too excited, we need to get one thing crystal clear, and this is a direct quote from ICT. Seasonal tendencies are not a magic bullet. They're not a panacea. Just because the market did something for the last 40 years in a row doesn't mean it's guaranteed to do it again this year.
So let's be super clear here. This is not a crystal ball. Think of it as one more powerful tool you can add to your toolkit. The whole point is to look for confluence, to see if this historical roadmap lines up with what your other forms of analysis are already telling you.
All right, enough theory, right? Let's make this real. We're going to dive in and decode the seasonal tendencies for the Canadian dollar. Okay, so what are we looking at here? This is the seasonal tendency chart for Canadian dollar futures. That blue line, that's the average of 40 years of data. The red line is a more recent 15-year average. And what's really cool is that they're both telling pretty much the exact same story. That gives us a lot of confidence in the pattern.
Now, zoom in with me for a second on the period between mid-March and early June. You see that? It's a very obvious, historically strong tendency for the Canadian dollar to rally. Just based on this chart, you'd think, wow, that seems like a great time to be a buyer of Canadian dollar futures.
But wait a minute. Most of us are trading Forex pairs, not futures contracts. So how does a rally in the Canadian dollar futures help us if we're looking at the USD/CAD pair on our screens? This is where it gets really important.
And that brings us to what might be the most critical part of this whole video, the Forex inversion twist. Get this wrong, and this roadmap will actually send you in the complete opposite direction of where you want to go.
Okay, let's break this down nice and slow. In the futures market, you're trading the Canadian dollar itself. So if the Canadian dollar gets stronger, the price of the futures contract goes up. Makes sense, right? But in the Forex pair, USD/CAD, the US dollar is listed first. It's the base currency. So if the Canadian dollar gets stronger, it's actually pushing the value of the pair down. It's an inverse, or opposite relationship.
So, if we want to find a time of year to buy USD CAD, we have to flip our thinking. We need to look for a time when the Canadian dollar futures are historically weak, and look right here. From September through December, the futures chart shows a strong tendency to fall, and because of that inversion we just talked about, this weakness in the Canadian dollar actually becomes a potential bullish opportunity for the USD CAD pair.
All right, that's the theory. Sounds pretty cool, but does this stuff actually work? Does it show up on the charts in the real world? Let's go find out.
Okay, here's where the rubber meets the road. This is a weekly chart of USD/CAD. I've highlighted that September to December window for every single year. Look at 2008 on the far left, a monster rally, right on schedule. Now look at 2011, 12, 13, 14, and 2015. It's just incredible. Year after year, in that specific window, the market gave us a major rally, just like the inverted tendency suggested.
But, and this is a huge but, look closely at 2009 and 2010. See that? The rally was pretty pathetic, or it just didn't happen at all. Why? Because the overall, big picture trend was strongly bearish. And this is the key takeaway. Seasonals are like a tailwind. They work best when they're pushing you in the direction the market is already going. You never ever trade them blindly against the primary trend.
So, we've got our seasonal tendency, and we've lined it up with the macro trend. You think that's good confluence? Well, what if we could add one more powerful layer of confirmation? We can. Let's talk about inter-market correlation.
This is so cool. See, Canada's #1 export is crude oil. Their economies are tied at the hip, so it makes sense that their seasonal tendencies would be similar too. On the left is our Canadian dollar chart, with that rally from March to June. And on the right, that's the seasonal chart for crude oil. Look at that. It's almost an identical pattern during the exact same time of year. That's some powerful confirmation.
And here's the real kicker. This is a weekly chart of crude oil during a massive multi-year bear market. Price was falling off a cliff. But even then, look what happened between March and June in 2014, 2015, and 2016. Every single time, the price produced a respectable rally, right on schedule. It just shows you how powerful these underlying seasonal currents can be.
So, after all that, how do we boil this down into something practical, a real edge that you can actually use in your trading? Let's lay out the final takeaway.
Here it is, your 5-step playbook. 1. You find the raw seasonal tendency, usually from futures data. 2. And this is the one you can't forget, you check for those Forex inversion rules. 3. You make sure this tendency is flowing with the primary market trend, not against it. 4. For that extra shot of confidence, you look for confirmation from a correlated market. And 5. When all those stars align, that's when you have a high probability framework for a trade.
You know, when you start putting all these pieces together, the seasonals, the trend, the correlations, you start to see the market in a completely new light. It's not so random anymore. And as ICT himself says, when you see it line up time and time again, is it hard not to feel like they're treasure maps? I really hope this breakdown helped connect some dots for you. If you got some value out of this video, do me a favor and hit that like button and subscribe so you don't miss the next one. If you've got any questions at all, just drop them in the comments section. A real person will get back to you. Thanks for watching, and as always, safe trading.